Also with us, Michael Vogelzang, the Chief Investment Officer of Boston Advisors, which manages $1.7 billion. In late 2009, Michael said that stocks would likely retreat in the spring. How right he was. And certainly a big thing, a focal point getting underway. JP Morgan coming out tomorrow. What are you expecting, and what do you think that's going to do in terms of market direction here?
Well, I think the bigger question, we haven't looked at JP Morgan. I think they're going to show some strength in certain areas and weaknesses in others. But I think the big issue right now is this whole idea of the macro environment weakening. We're continuing to see the FOMC comments today talked about a weakening economic environment. And yet corporate America seems to be in fight and trim. They seem to be in great shape and doing really well with expense control. The discipline there is great. And if Alcoa and Intel can tell you two things about two pretty different companies, they're saying a lot. They're telling us that corporate earnings might actually be pretty good. So that's going to be an interesting battle.
They do have those corporate balance sheets, a lot of cash on hand, but they're not necessarily putting anything to work when it comes to hiring workers. Michael, until we see that, are we not going to see significant improvement in the economy and the economic outlook?
Well, more importantly, we're not going to see significant inflation pressures until we start to see a much lower unemployment rate, right? So that the labor is in essence free. I mean, we can. I'm sure everybody in our business is talking to lots of people who are looking for jobs, and that's just our business. So, the price of labor is very, very muted. It's not going to go up anytime soon, and we don't expect unemployment rate to come down for quite some time. So that's going to give companies a lot of leverage in their income statements.
Michael, one thing I noticed in my notes here is that you folks have actually begun adding to your equity positions because of some of those early positive earnings announcements. How aggressively are you adding to those positions?
At the margin, right? But that's important. We've been pretty negative for the last 6 or 9 months, as you mentioned, and we sort of felt that we think the market might still get down to 950 this summer. We're a little bit worried about that low side. That seems to be a pretty common technically watched area. But you know what? I think with a good earnings season, there's been so much negative talk about this earnings season coming in, and all of a sudden seeing two very, very big companies have very strong earnings. We think there's a lot of dynamic activity going on in corporate America, much more so than the general economy, and at the end of the day, stocks are going to get priced off of earnings. So we're doing at the margin, but it's a big change for us.
Hey, Mike, it's Julie here. I talked earlier today to a guy named Nick Bloom. He's a professor at Stanford. He's been studying uncertainty and its effect on the markets. And this goes back to what Dan was talking about, that he's seeing a bit in the VIX right now. And basically, Carol...
We've actually got sound from him.
We do. Let's listen to him.
Because he's looked at a lot of research. Here, listen to this, everybody.
I've looked at 17 prior uncertainty shocks, things going all the way back to the Cuban Missile Crisis, assassination of JFK, through to 9/11. And on average, what you see is uncertainty spikes after some nasty event. For example, right now, the kind of fiscal crisis, stocks plunge, the economy plunges because, of course, firms wait. When firms are uncertain about the future, the best thing to do is to pause hiring and pause investing, and consumers do the same. But once uncertainty passes, they get back into action again, and the stock market typically recovers.
So, Michael, I guess the question is, does that theory make sense to you, that uncertainty is going to subside here, and that's also going to help stocks rally?
Well, I mean, I think he's talking about, and I would sort of interpret his comments about subsiding over the fiscal crisis from last year. And if you look at where we were from a shock and awe perspective, March of 2009 to where we've come today, clearly things are a lot better. Clearly hiring has improved. The business climate has improved. I mean, we came to a full stop at the first quarter of 2009. Economically across every company in the United States. Hiring stopped, layoffs occurred, et cetera, et cetera. We've come a huge ways from there, and I think the shock is much lower. I think people are getting back to normal business patterns, and I think you're starting to see that in some corporate earnings.
I think he's even somewhat talking also about the European fiscal situation that we're seeing, and that even as uncertainty wraps up over that we'll see more of an upsurge in stocks.
Yeah, I mean, I think that's a fair point. Certainly the downdraft in May and June was caused by the European debt crisis and the European currency crisis. As that gets a little more solid, and as Germany voices its confidence to stay in the euro, all those kinds of things happen. I think you'll see those markets recover and those companies get back to normal. But I think it's a pretty standard pattern. I don't think it's earth-shattering academic research.
Hey, Michael, it's Adam. I like what you're saying, but give me something I can sink my teeth into. A couple of names, a couple of groups. You said you're nibbling. I'm all ears.
Yeah, yeah. Well, that's the hard question, isn't it? We've been adding to some of our consumer discretionary a bit after this particularly sharp pullback. We own a little bit of Gap shares, for example, and a few others. In the technology area, we continue to be intrigued by technology. We are looking consistently at Microsoft, frankly, for the first time in almost as long as I can remember, down at these levels, trading at close to single-digit earnings estimates. So, those are some of the names that we think are interesting here. The previous earnings estimates for really the earnings seasons for the last year have been met with very, very different markets. The market anticipated good earnings and ran up ahead of them. This was a very, very different environment, and it's part of the reason why we're a little more optimistic.
Let me just ask you, the Fed coming out, those FOMC meetings, they're bringing in some of their estimates there. They're saying we don't need stimulus or any more stimulus at this point. I talked to Governor Granholm of the state of Michigan. She says otherwise, and she sees it, every day, the troubles in her state. I mean, Mike, do you think we need more stimulus here?
Well, I'm not a government policy official maker. At the end of the day, I think the economy is going to heal. It's time and price, right? And so, we expect. One of the things that's very interesting to me is that a lot of people in the investment community, a lot of our clients, a lot of big institutional investors are seemingly petrified of inflation. Mm-hmm. We frankly just don't see it. The capital is free and it will remain very, very inexpensive. Okay. As I said earlier, labor is very inexpensive. We just don't see inflation coming back for a long time.